What's going on, YouTube? It's your boy Charles Enoch. Y'all already know we back with another Invest in Myself episode. So run the intro. So today we'll be going over how to pay off your mortgage quickly using a home equity line of credit. But before we get started, you already know your boy got to do the YouTube thing. My goal is to reach 10,000 subscribers by the end of this year. I know it's a crazy goal, but it's my goal. So I appreciate you guys if you did all three of those things for me. So every time I explain paying off a loan, or in this case, paying off a mortgage, everyone is concerned about paying off the line of credit, even though it's calculated by simple interest. This means you're going to pay your debt down quicker, and it's going to charge less interest when you use the velocity banking method. So before we get started with the scenario, I'm going to show you guys how to calculate simple interest using your HELOC and why you shouldn't be concerned. So I'll be doing a series of 4 videos, which will use the mortgage payoff calculator to see how, when we do our chunk payments on our HELOC, how that affects our mortgage, why and how we can pay our mortgage down a lot quicker. So enough talking. Let's dive into one of the examples. Let's go. All right. So before we get started and get to the mortgage payoff spreadsheet, I want to go over and break down simple interest in the equation so we can get a full understanding of what simple interest is when we're using the HELOC. So the simple interest equation is pretty much going to be your HELOC amount times whatever the percentage on your HELOC is divided by 12, since there's 12 months in a year. So I'm going to have an example. The HELOC is going to be $25,000 that we have. The percentage is going to be 8% for the HELOC. So if we do that here, we're looking at 25,000 times 0.08 for that 8% divided by 12, and we get 166.66. So $166.66 is what you would be paying per month if you took the 25K out and you didn't put anything on it throughout the whole month. Again, this is calculated daily. So let's say you took out the 25,000 and then the next day you put 25,000 back in. You're not going to pay the 166.66. So just another quick example, let's do 20,000 times 0.08 divided by 12, 133.33. So that's pretty much the equation when you're putting, let's say, that 25,000 onto your mortgage. And then, like I said, when we do the equation here, you'll see a lot of interest fly off. This is how much interest you would particularly be paying per that month if you just kept the 25,000 in. Now, again, we pretty much put our paychecks into that line of credit to minimize that. So that's the simple interest equation here. So let's move on to a particular example in regards to paying off of our mortgage. All right, so we're back with a part 2, a scenario 2 for paying down your mortgage using that HELOC. We have the amortization payoff calculator. So let's go over the second scenario here. So we have the loan amount. We're going to say a couple bought a house for $1 million. So this would be kind of on that maybe east or west coast, where the housing prices are pretty high here. So we'll do a scenario like that. So have a loan amount of $1 million, interest rate 8%. Pretty much the standard 30-year fixed mortgage. So 30 years, 12 payments per year. Let's say it pretty much starts today, the day that I'm making the video here. So let's look at the loan summary. Payment a little over $7,000 a month. 360 payments for the 30-year mortgage, typical here. So we see the interest. In the interest, obviously we're paying double basically, or more than the house or than the loan itself, right? So paying 1.6 mil on the $1 million loan amount here. So kind of crazy here. So pretty much what we want to do, just going to kind of use the standard example that we had for the HELOC when we were doing that simple interest equation here. So say this couple has a 25K HELOC at 8% here. So that's the 166 that they would pay monthly here. So what we first want to look at here, amortization payoff calculator. It's basically telling you, hey, if you make your scheduled payment, this is how much you pay in principal, this is how much in interest, and you can see as it starts 600, but when you get down, you're getting more towards paying that principal than interest. So when you're using Velocity Banking, you definitely want to use it in the beginning years of your mortgage, because pretty much that extra payment is going all towards principal. And what it's doing here is, let's say the payment number, if we put $25,000 more, then it's pretty much making the amortization scheduled payment go down to, let's say, payment 25 or something like that, since you're putting that extra on there. So let's look at things here and see how Velocity Banking can help you guys out here. So the total interest 1.6, right? If let's say that this couple, they did their regular scheduled payment, and on top of that they used their HELOC $25,000 to put an extra payment on there, right? So when they do that, we see the total interest goes to 1.4 here. So just some quick math here, is that a little over 200,000 that you save just off of that payment. Now again, we know that with the HELOC and the simple interest, it's 166 a month when you have 25,000 of debt on the HELOC. Now we're going to say that to make it really simple, their cash flow is $1,000. So it's going to take them pretty much 25 months to pay back the HELOC. 26 if you add your interest or whatever the case is. But we just want to make it simple here. So I'm going to go down to payment number 26, because that would be the 26th month here. Let's say they're ready to put another 25,000 on there, right? So the total interest 1.4 mil. We put another 25 on there, right? We're at 1.2. So it's a little about 150,000 saved in total interest. Now the thing is to realize, when you start at the beginning, that's when it's going to hit most of that interest. So payment one, when you put that extra payment, it was a little over 200,000. This second one about 150. So again, this goes into the more of, you're paying less interest as the whatever payment amount you're on. So again, if we look, I scroll way too far down, but we look at the last payment, look how much the principal is compared to the interest, right? So again, this would not be wise. Like if you're on year 29 or something, I mean, you're already paying a lot of the principal. The interest isn't really there. So you want to start this Velocity Banking again on the beginning stages, because that's going to reduce that total interest. And again, we know that we're going to be paying simple interest on the HELOC, which is peanuts compared to how much you're saving. So this is definitely a great way to pay down that mortgage in pretty much half the time. So if this video was helpful, definitely like, subscribe, leave a comment down below. And like always, man, you guys have a good day. Appreciate you guys. Peace out.